Hey, before you go into today's video, please note that I filmed this before the news came out that Realty Income would acquire Spirit Realty Capital in a $9.3 billion deal. I think that this transaction only reinforces what I say in this video, so please make sure to watch it till the very end. Enjoy. Realty Income will release its third quarter results on the 6th of November, and this has led quite a few of you to ask me whether now could be a good time to buy shares of the company before its earnings come out. Hey everyone, this is Yoshi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to explain to you why I think that now could be a particularly good time to invest in Realty Income. But before I get into it, could you please do me a huge favor and like this video? That really helped me a lot to grow this channel. Thank you so much for all your support. So before I explain to you why I think that today specifically could be a good time to invest in Realty Income, let's go back a bit. Just recently we posted a video in which we explained why we are finally buying Realty Income. In short, until recently, we argued that there were better opportunities in the market because Realty Income was priced at a small premium relative to its peer group, and that's despite growing at a slower pace. But this all changed with the recent crash. Realty Income share price has dropped a lot, and as a result it's today priced at a small discount relative to its peers, trading at just 12 times FFO and a 6% dividend yield, which is also slightly higher than its peer group. Therefore, if you're a conservative, income-oriented investor who isn't seeking to maximize total returns, we think that Realty Income is a great pick at today's share price. And especially today, we think that Realty Income could be a great buy ahead of its earnings because most of its peers have already released their earnings reports and they've been really strong. Vici Properties boosted its 2023 guidance on the back of strong acquisition volumes, and it's now guiding to grow its FFO per share by 11% this year alone. Essential Properties Realty Trust also hiked its full-year guidance for 2023, and it also guided for steady mid-single-digit growth in 2024 and 2025, even despite the surge in interest rates. Then EPRA Properties also lifted its full-year guidance, and it also reported that its net lease theaters have now seen their rent coverage ratios recover to pre-pandemic levels, which is very positive if you followed EPR closely. After that comes Agri Realty, which also beat expectations this quarter, and it also guided for steady growth in the years ahead. Agri Realty explains that they should be able to grow their AFFO per share by at least 3% per year, even without having to access the capital markets. That's because they have attractive rent escalations in their leases, they retain significant cash flow to reinvest in growth, and they have no debt maturities until 2028. And then finally, NETStreet also beat expectations this quarter, also hiked its full-year guidance, and also guided for steady growth in the years ahead. So across the board, net lease REITs did quite a bit better than expected in the past quarter, and this is obviously very positive for Realty Income. It means that the net lease property sector is doing really well, but despite that, Realty Income is still today trading at near its lowest point, and none of this positive information has yet been priced into its stock. And while I don't have a crystal ball, I think that all these positive results also increase the likelihood that Realty Income is going to report strong results that will positively surprise the market on the 6th of November. It seems that net lease REITs have done so well in the recent quarter because they've been able to acquire a lot of properties at great cap rates. Net lease REITs use relatively low leverage compared to most private investors, and this puts them in a strong position in today's market. On average, the LTVs of net lease REITs are around 35% compared to close to 60% for private investors, and as a result, net lease REITs are now in a strong position to acquire properties at low prices from distressed and over-leveraged private investors. I think that the recent commentary from the CEO of Agri Realty is especially interesting for Realty Income because both are very similar net lease REITs that focus on Class A properties. Here's what he said on their most recent earnings call. We continue to push cap rates higher during the quarter without sacrificing quality and maintaining our underwriting criteria. Within our targeted sandbox, there continues to be a lack of capitalized competition, and our track record of execution makes us the buyer of choice in today's market. We anticipate this dynamic will persist, and consequently cap rates will continue to move higher, albeit slower and steadily given the large and fragmented nature of the net lease market. Then later he also added that we acquired properties at a weighted average cap rate of nearly 7%, a 10 basis points expansion relative to the second quarter, and 70 basis point expansion relative to the full year of 2022. So this shows you clearly that cap rates have moved up, and this allows these REITs now to pick up assets at very attractive yields. The CEO of NETStreet also made a very interesting remark concerning this topic. He said that we are seeing significantly more opportunity for acquisitions in the fourth quarter at higher cap rates than what we've seen in 2023. And I think that Realty Income is ideally positioned to benefit from this because it's the only net lease REIT with an A-rated balance sheet and access to debt even in the European market where interest rates are quite a bit lower. This gives Realty Income a competitive advantage because it should be able to access significant liquidity at a relatively low cost to buy now higher yielding properties, resulting in nice spreads over its cost of capital. So based on all these recent results from net lease REITs as well as the remarks from their CEOs, I'm quite optimistic about Realty Income in the coming quarters. And so if I didn't own a position today, I probably wouldn't wait till it reports its earnings because more likely than not, I think that the results are going to be quite positive. But with all that said, I want to remind you that I don't have a crystal ball. I can't predict what the market will do in the short run. Perhaps Realty Income is going to report really strong results and the share price is going to drop anyway, or Realty Income may even disappoint the market in the near term. But none of that really matters that much. What should matter to long-term oriented investors is that valuations are today historically low, even as the net lease sector is doing really well. Lease defaults are really rare in today's net lease market, rents keep steadily rising, and the cap rates are now also quite a bit more attractive than just 12 months ago, and well-capitalized REITs like Realty Income should be able to take advantage of that over the coming years. Despite that, Realty Income is today priced at just 12 times FFO, a 6% dividend yield, which is a historically low valuation for the company, and I'm buying the stock ahead of its earnings. And now finally, if you want to access my entire real money REIT portfolio, feel free to join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link to it somewhere in the description of this video. And otherwise, once more, if you could please like the video, that really helped me a lot to grow this channel. Thank you so much for all your support and see you at my next one. Bye bye.